Hi, my name is Mauro Peña, and this is my video for the evidence of investment vehicles. So, for the justification of the commodity, we chose natural gas because we believe that it has a much stronger and a more realistic outlook than crude oil for the end of this year and also for all the next year. Because while crude oil is facing oversupply, rising inventories, and also weaker demand, especially from China, natural gas is getting support from a solid and a long-term structural demand because in the US, supply is tight, but the demand is climbing fast, mainly due to the expansion of liquefied natural gas and the rapid growth of AI data centers, because these ones require constant and reliable energy. Also, China is shifting away from coal and moving towards natural gas, which creates a stable global demand that crude oil does not have right now. And because of that, we expect Henry Hub prices to move into a higher range, around 4.5 and $5. So overall, natural gas offers a more reliable market trends and also a very marked seasonality, better supply and demand conditions, and thus gives us also the best conditions to use derivatives. As I just mentioned, there is a really marked seasonality. Here we analyze the last 18 years of data about the prices of Henry Hub natural gas, where we saw really marked bearish movements in January, where 15 of the 18 years analyzed were having this bearish trend. And for April, 14 of the 18 years had a bullish trend. Here we can see how high or low these movements were, so we can take advantage of that known movements of the market with our future positions, where in December and January that there are these large low returns, we can take a short position in those 2 months and a long position in April and September to take advantage of this increase on the prices. So to really do this um, strategy, we need to also take into consideration the tax rate that is 30%, also the exchange fees, broker commissions, regulatory fees, and slippage. Okay, so after considering all these costs, our maximum possible profit is of $18,011, meaning a return of 10.74%. And this maximum possible profit is based on the following exit strategy. So we selected two exit strategies. The first one is the take profit order, where we are going to take the profit automatically if the prices go to these ones right here. Meaning that, and what are these prices? These prices are are based on the forecast that we did. So if the prices go over there, we are going to get these gains depending on the position of each month. And at the end, if all these scenarios are complied, we get a gross profit of 15.4%. But what happened if we are losing money? If we are losing money, we have this exit strategy that is for losses, meaning that if a position, for example, January, reaches this price, it means that it had a 7% loss and we will cancel the position. So, in our worst case scenario, that none of the strategies reach the previous levels and reach these prices that are losses, our maximum loss from a 167 698 investment is of minus $11,739, meaning a minus 7% if all those strategies were lost. And if neither this stop limit or the take profit order is triggered, the positions will be closed 1 week before the expiration of the contract. Because since they are futures, we will have to deal with the delivery costs, and we do not want that. And in order to do that, we will want to close them. This is possible since natural gas is one of the commodities with the highest volume. And we believe this strategy is the best one because in the other ones, we do not take full advantage of these marked movements of the price of natural gas. And with options, they have a really high premium. And here, since they are futures, we do not have this upfront payment that is really high. So finally, the trigger points that can impact the strategy are for the first one is that if the forecast that we did does not match a lot and deviates more than 15%, we will take these forecasts as invalid and look for closing the positions. Also, we need to manually check if there are unexpected events, macro or even in the energy sector, that can affect the supply and demand, also needing to close the position. And the other 2 points are the volatility. If we see that the volatility is higher than two standard deviations from the 12 months average, it means that it exceeds the risk that we want for the client. So we will have to also manually close this position. And the last trigger point is the stop loss that we already explained, that it is automatically closed if a position reach a 7% loss. So that's mainly it about the reasons that we choose this strategy, this commodity, and etc.